Today was a textbook risk-off day today. Stocks dropped sharply as oil prices surged at nearly 7% overnight, and volatility spiked 15% or almost 15% following a major escalation in the Middle East between Iran and Israel. The S&P 500 pulled back from recent highs. Small cap stocks got hit the hardest. Defensive sectors held up the best, as you would expect, with technology and financial selling off. In this video, I'll break down what triggered this rotation. We all kind of know what happened. We'll talk about how and why and what moves especially on an intermarket basis, are making, and what the rotation is showing on on the sector rotation. We'll talk about where key support levels are for any kind of decline we may get, and why rising yields and volatility and really rising oil prices combined could shift the market tone heading into next week. So let's go ahead and get started. Today is Friday, June 13th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, remember today is the last one where the full video will be right here. Starting on Monday, this will be a shortened video, kind of a preview video that will be public facing that anybody can see on YouTube. Just be the kind of the first Market Outlook segment of the broadcast of this of my video here. And then this link right here, starting on Monday, will take you to the full version of the Market Outlook video. So keep that in mind. It's a big change coming up. Remember, if you want to see the full version, you have to subscribe for our foundation tier. Our foundation tier, as you can see, is a here. Let's pull up the page here. The foundation tier is allows you to see the Market Outlook video every day, as well as the Market Outlook live video, where I take a look at the trades from old Market Outlooks and see whether we should stay in them or get out of them or not. You can also see too, that's $29 a month for the monthly version, or you get 2 months for free if you sign up for the yearly version at $2.99 a year. And again, monthly it comes out to about $1.40 a video. If you do the yearly, it comes out to about $1.20, a little bit less than $1.20 a video. So doesn't cost very much, but allows you to see the entire video here going forward. So that will be here on the month Market Outlook tier. You can also see down here at the bottom, there's another way you can subscribe. But starting on Monday, the way to watch, if you are subscribed, the way to watch the full video is by clicking on this button, and that will take you to our new page that, like I said, will be live on Monday there. As of right now, you'll be able to see the video here. This is where you see the Market Outlook live up here at the top. You can also get to the Market Outlook live up here as well. If I were to click on that, you can kind of see what this looks like. Again, it's a live stream, YouTube live stream. I take a look at all the trades. We manage trades. We also put on the day's trade before the market closes. So we do that here. And then you can see all the old Market Outlook lives are archived down here at the bottom. So that's what you get when you subscribe to our foundation tier. And you can see when you go to the pricing page, eventually it'll get there. You can see the different plans. There's your foundation plan. And then the core and premium include our trading rooms, as well as the foundation level. And of course, our elite level subscribers lock in the price of the premium at a much lower price than what they get here for the 3 years. So if you want to see the Market Outlook post, the full version of that post, you do need at least have a free subscription to the site to be able to see the post here. And again, you can just log in up here in the top right. It'll say log in there. All right, now let's break down what's going on here. As you can see, and we do have a pretty significant decline. I mean, it's 1%, a little bit more than 1%. It's still, I mean, we're below the 2.5% mark, above the moving average, but we're not below zero, right? So at the very least, we're still positive. We can be positive for a long time. You can see if I were to go back to the last time we kind of surged above the 5% mark, which would be Let's see, well, at least over the 2.5% mark. When we got below the 2.5% mark, we didn't drop to zero for a long time. Same thing over here. I mean, we can stay hovering around plus or minus this 2.5% for a long time. So that's not an issue. Like, it's not too, it is a down day, and we did close below the low of the high day, right? The highest day being a couple days ago with the highest high, and has been 2 days now without a new high. But I mean, like, this pattern right here is a bullish pattern. The strong bullish posture on the intermediate line above the 90th percentile still, despite the decline. The near-term line dropping below 50, not that big of a deal. It's not in bearish territory, and it's definitely not in oversold levels where we'd really be concerned, like with a drop like this, right over here. So we're not. I mean, that's not an issue yet. Or even over here, you can see when that decline started, we had a very bearish short-term sentiment. The momentum line, like on these other instances, the momentum line got to extreme lows. That did not happen here, so we're okay there from that perspective, below the 5th percentile, but it is oversold. So that combination of a strong intermediate posture and an oversold momentum line is a bullish pattern, especially with the near-term line at least below 50. It would have been better below 40, but at least being below 50 sets us up for a bounce going into Monday. Like, now again, anything can happen over the weekend. We don't know what's going to happen on Monday, but this particular pattern right here suggests, from a technical perspective, that the market is poised to bounce in the short term on Monday, and that's what we can expect unless we see something otherwise, and unless the news headlines come out and something happens over the weekend that the market was not anticipating with the sell-off. Because, again, with the sell-off, the market is anticipating something to happen, right? But if nothing happens that's unanticipated, then, again, the technical environment is set up for a short-term bounce, like the last time we had this intermediate confirmation signal, which would have been, last Thursday, when we had the drop on last Thursday, and we bounced back up and we gapped up on Friday and then kept going up here. So that's the pattern we're seeing on the S&P. If you take a look at the NASDAQ 100, it was down about the same, has the same pattern. Its near-term line is below the 40th percentile. So this is, again, textbook buy the dip signal. I mean, it's called a bullish intermediate confirmation signal, but that is a textbook buy the dip signal there. So that's something that we can expect should bounce up and start to move higher again with that intermediate line. So that's exactly what we want to see. If I take a look at the Dow Jones Industrial Average, again, it looks like the S&P. They're very correlated. The intermediate line's below the 90th percentile, but still strongly bullish. And we are barely above the 30-day moving average. So it's a little different in that regard. We did drop, 1.8% there. So a little bit more than the S&P in general. But you can see, like, we're barely above the 30 days. So that's something to keep an eye on as we, if we don't get that dip bounce on Monday. And you can see the Russell 2000. Again, it is a higher beta index, so you're going to get more significantly weak short-term sentiment patterns than you will on the S&P 500 because it is a higher beta index. But the intermediate line still above 80. It is dropped below 90, but at least it's still above 80. The market sentiment line is still rising. We're still above it, just like all the other indexes. But your near-term line did drop below 20, and your momentum line had dropped below to extreme lows on Wednesday. We're on a 3-day decline for the Russell 2000, and now it's down to almost extreme lows again. So, I mean, if the S&P 500 was showing this pattern, then we'd be a little concerned, right? You can see day one of us dropping below 60. We had only dropped below 60, but your momentum line was extreme lows. And then, again, by day two, we were almost below 20, and now today we are. So, so that kind of short-term pattern, again, if this were the S&P 500, we'd be pretty concerned about that as the potential for starting a new intermediate decline. Because, again, the intermediate declines typically start because you have to reverse a strong bullish sentiment. So it has to start with something to kind of give it, to break it, right? To break that bullish sentiment. And so you typically have to have a pretty significantly bearish short-term sentiment. Now, see, we had that over here too, and we bounced because the Russell tends to be more volatile. It's a higher beta index. It tends to be more volatile, so you're going to get more indexes or more signals like this. But the Russell 2000 also can lead, right? It led the S&P, and then the correction. It started the correction a lot earlier than the S&P did, and we'll see if it ends up leading. If this ends up again, you expect that we'll bounce, but the odds aren't as high as they are for the large cap indexes because of how bearish this is. So we'll see if it follows suit with the other indexes because of their patterns, or will their patterns follow the Russell and take another leg lower or take another day lower to more bearish levels on the short term that we really want to see on the S&P and the other indexes. All right, now let's take a look at the weekly chart, because we just finished the week. Oops, not that one, sorry. It'd be this one here. So, strong bullish, and for the most of the week, we were trading above the Heikin-Ashi close. We are no longer trading above the Heikin-Ashi close. So it is a higher close, we did get a higher high, so that's bullish. But the midpoint of the range is right around 59.50. We are above that, so that's not as bad, but we are below the close. So we are setting ourselves up for a transition candle to occur next week. Right, so the open will be, 59.48. We will open up, barring a gap down, we will most likely open up above it. And the question will be, what kind, if we end up with a transition candle, which is a small body, an upper and a lower shadow, that can be a reversal pattern if the actual candle next week is bearish. So what this is saying is that, again, that next week's candle has a high probability of being a transition candle. And transition candles can be reversal candles if the actual candle is bearish. So there's a good chance that next week's candle is pretty bearish from that perspective. If it's not, we're fine, right? But if it is, then that's the reversal, right? That's the signal, and we can know pretty quickly with that market forecast if it's going to be like, as we get into Monday, Tuesday, and Wednesday, as we see, what the short-term signals are looking like. So next week, we really need to be paying close attention to any signs that we might be getting, beginning in the beginning stages of, again, not a bear market, not a correction, but just the beginning stages of at the very least a 5% decline, right? If you see on the zigzag, we've already gotten up 17%, and we're currently down 1. But are we going to be in the beginning stages by next week of a 5% decline, where we get down into this, to this area? This is where the 5% mark would be, which would not be a bad thing, because then because you can see every time we get a 5% tag or more, we get a double-digit green tag follow. So that wouldn't be a bad thing if we got that. But obviously, there'll be wailing and gnashing of teeth in the process of getting to that 5% drop. But we would all know that, hey, that's going to set us up for, because if we get a double-digit tag after that, we're busting through that old high. So I wouldn't mind that at all. Let's take a look at the 3 green arrow charts. We were so closely, we did get 3 red arrows in the Dow and the Russell. We don't have 3 red arrows anymore. Their MACD has turned red. The stochastics, the MACD for the S&P and the NASDAQ have already been red. They've been red this whole time. So we still don't have 3 red arrows there, or 3 green arrows. But at least, again, we only have the 1 red, and 1 or 2 reds is actually not bad either, right? It's when you get that third and we follow through on that. But even 3 red arrows itself, when you're on a bullish trend like this, it's that inflection point. It either starts a new bearish trend or it's a bounce trade. And until we've proven otherwise, we expect a bounce when we get 3 red arrows. So getting 1 or 2 is not a bad thing either. When you look at the 2-line version of this chart, you can see it. Hold on, we'll fix it here in just a second. I don't know why. There we go. So, we're sitting right at the point of control. We are below the 8-day. We're nowhere near the 30, much less the 50 or 200. The MACD has been below its average this whole time, but we're still above the 17. So we're still above the 17-day moving average. And again, we don't really have to worry about the beginning stages of the decline until we really break the 17. And we really kind of need to break the 17 and the 30 on the same day. Now that can happen if we get a strong drop on Monday or sometime during the week next week, Monday or Tuesday most likely, because we're pretty close to the 17-day. If we get a strong 2% decline, then we will drop below both of those. But that's kind of what we need. And of course, I don't expect that to happen. I don't think anybody else expects that to happen. But otherwise, we probably would have started to sell off a little bit more today if we were expecting that. But we know pretty decent volume today, but still holding, the kind of important intermediate declines, even if we're slightly below the short-term 8-day exponential moving average. If you take a look at the DMI, again, I don't know, I need to fix this bar. I don't know why it keeps doing this. Here we go. Let's just fix that. So we are the negative indicators above 25, right? So it crossed above the positive, and the positive indicators drop below 25. So I mean, just like that, like I mean, that's. But again, it can do this. You know, it did this over here, got above 25. The negative indicator got below 20, and we bounced. So getting to a 3 red arrow signal is not a bad thing. But that, you know, it is something to be aware of. Like we have, that's a crossover. The ADX is already back below 20. And we'll see if this is just a kind of a 1 or 2 day dip, because this happens a lot, and then that's it. You can see it happen over here in reverse, right? We were negative this time, and we dropped below 25 on the negative and above 20 on the positive, and we reversed, and did a little bit here too with a little dip below 25 on the negative before reversing there. So it can happen. In this case, it's happening in, you know, the other way. So we'll see if, I mean, again, until proven otherwise, we kind of expect that it would bounce. The RSI and the CCI are still okay. Like we're below 60 on the RSI, but we're not below 50. So I can still continue with this drawing, this green drawing here, going forward. And then, you know, we're still actually above 0 on the CCI. So we're not trending. We're not at trending levels, but we're still positive. We're not at bearish levels at all either. If you take a look at the Ichimoku cloud, we're still, you know, we're flirting, you know, we're below the midpoint of the 9-day range, but we're still well above the midpoint of the 26-day range, which is the blue line. Still have a very positive rate of change. That hasn't changed anything. I mean, it is declining. The rate of change, the 26-day rate of change is declining, but it hasn't dropped below the 5% mark, and it has clearly not gotten below 0. So no issues there on the Ichimoku cloud, way up above the cloud, still a very mature trend. So, but you know, we are getting closer. Like we were so far away from the midpoint of the 26-day range, but that gap is shrinking as we just kind of grind. And again, it makes us more, because again, once you break that blue line, it typically ends the mature trend. And usually mature trends, when they end, they end with an intermediate pullback. So we'll kind of keep our eyes on that. If you take a look at the Bollinger Bands, obviously we're not above the upper band anymore. We're not even in the upper quartile anymore of a very small bandwidth. It's a pretty small compared to where we've been. The bands, though, are outside of the Keltner channels, and you can see the momentum, you know, has been kind of fluctuating, but you do have green dots, so we are slightly outside the Keltners, and we'll kind of keep our eyes on that as well, and easily still in the upper half of this range, this 20-day exponential moving average. So we're still bullish. We're just not, you know, we're not pushing higher, but, you know, the drop today didn't change the bullish trend yet. It's definitely not trend changing in the least bit. If you take a look at the intraday moves, again, 2 days in a row now without a new high, and you know, we're pretty decently below the new high now. So we're kind of, you know, again, we went you know, a couple of weeks without a new high here before getting back up. So, you know, it's not out of, you know, here's that move right there. So it's okay. It doesn't change the trend, but it was a lower high and a lower low. We did close below yesterday's low. So, you know, so there is, I mean, we haven't had that kind of pattern in a long time. So, you know, that is some weakness, and that typically leads to some more short-term weakness. The good thing is that the 4-week point of control, which is an intraday support, is right at the chart's midpoint. So, which is also kind of active to support. So we can get a little bit of a drop and still, you know, be in bullish, at least the upper half of the chart. I mean, we're still in bullish territory as it is right now. So we're not, you know, that's okay too. You know, the volume, obviously you saw the volume picked up today and was above average at 89 million. The range, though, did not pick up. So, you know, it was a relatively small range. The range continues to drop. I mean, the ATR picked up a little bit with the gap overnight, but not significantly. You can see the volume was up high, but not abnormally high. And we've had higher volumes over here. And then finally, the VIX was the other thing that kind of moved up. It moved up out of bullish territory, out of risk on territory, and is now in neutral levels. This is risk off. Anything above 0.95 is risk off territory, and this would be risk on territory. And so we are in the neutral levels. And, you know, again, we talked about this yesterday. Like, we had a jump, you know, the VVIX had jumped up, you know, pretty strongly 2 days in a row. And then now we're up to over 110. Remember, when you close above 110 on the VVIX, you are susceptible to a jump in volatility, like a significant jump in volatility. So that's something to keep an eye on Monday too. Like that market forecast is giving us a buy the dip signal, but when you close above the averages like this and you get that jump above 110, then we're susceptible to this, right? To a move like this. So over here we close above the averages too, and so we were susceptible to that kind of move. So I'm not ruling out next week of this kind of move. I mean, those are rare, so the odds are they're not going to happen, but the environment is set up for that. So yes, there's a buy the dip signal, and we anticipate, you expect they will buy the dip, but we need to be aware that we're going into the weekend, setting up, and we're going into the week with that Hakunashi candle, setting up what could be a bearish week next week. So, we'll just watch really closely Monday, Tuesday, Wednesday. If we start to get those signals that will ultimately end up in a bearish week, or if not, then we can say, okay, good. Well, it's a transition week, but it's not a reversal. Volatility most likely will be coming back down, and we'll be back to normal again. But we know it's like, I use the tornado watch, tornado warning type things. When the VVIX is up as it is, and the VIX itself closes above 20 and closes above its long-term averages like that, then we're no longer in tornado watch territory. Now we're in tornado warning territory. So the conditions are there for a jump in volatility, and knowing that next week is set up on a Hakunashi basis to be a potentially bearish week, because it's going to be, it's set up to be a transition, which if it's bearish transition, it'll be a reversal. We need to be what, the tornado warning is in effect. The volatility tsunami, which is what Andrew Thrasher calls it in his award-winning paper from the CMT Association. He calls it a volatility tsunami. That the tsunami warnings are in effect right now because of the conditions that volatility are in. All right, now let's break down what's driving the price action today. And of course, it's the Israel's attack overnight, the retaliation here in the afternoon, which would be nighttime there. Significant impact on the markets, to say the least. Then this was just this wasn't even the overnight session, right? We gapped up to the upside in commodities. This is the commodity ETF up 3%, which you can see for that. I know crude oil was up quite a bit, but when you look at the commodity index, we've had other days like this, but we were down 4 days in a row to get that jump. But, other than that, like a big move, a big gap up to the upside and a big move higher. That's one of the, one of your bigger moves that you see in commodities. Obviously, gold rallying today as well. So kind of, obviously a risk off day. The dollar was up, gold was up, commodities were up, yields were up. So, in one aspect, long-term bonds did not act as a safe haven as yields continue to move higher. In fact, when you take a look at the 10-year yield, let's pull that chart up. When you take a look at the 10-year yield, it had been dropping, right? We had pretty much every day. Well, yeah, it was. Every day this week dropped on the 10-year yield until today, right? Today, big change to the upside. We had been on this bearish little run. You can see the MACD's been below its moving average. It got below zero. The question is, are we starting a new run after this to the upside, right? Well, the MACD is still below its average. It's still negative. We've had a run. We've had, last week, at the end of last week, on Thursday and Friday, we had a jump in yields, and that didn't turn into anything. We actually got above moving averages with that move. So, one day doesn't necessarily change anything, but it's something to monitor going into next week. Because remember, we are at that. This is a sweet spot, right? It's getting below this and getting below 4.25%. That's the concern, or getting above 4.5% is a concern. As long as we're in the middle, there's no concern necessarily from this. And of course, the other thing is the dollar index, and the dollar index was up today. But look at that. That's as much of a risk off day that we had today. Your dollar is still below all these moving averages down there. It's up 1/3%, but it's still easily below the 8 and 17-day moving averages. When you look at commodities, particularly crude oil, this is the big mover. Look at that jump and not surprising with what happened. You can see we were already moving going into this. We were talking about the big moves that it had, and but now it's just gone parabolic, right? You can see, like if I go back the last 5 years, this is one of the largest jumps in the PPO that we've had. I mean, outside of this, big parabolic move we had in March of 2022 when we hit 130, when we went from basically 90 up to 130. Well, we've gone from 60 to 70, right? So it's a pretty decent move, but nothing that we haven't seen, and all these other moves that had this kind of momentum all peaked at that level. So I mean, there's a good chance that this is the peak for crude oil on one hand. On the other hand, when you look at the DMI for crude oil, it's definitely gone parabolic here too in terms of like that's the biggest jump in the positive directional index again that we've had since that March 2022 timeframe. And you can see how high the ADX, but you can see at that point when we had that move, the ADX was already positive and pretty high. The ADX is not even above 25 yet, and your negative indicator is already below 10. So even this indicator suggests that this could be very short-lived. Usually when you get these big, short moves, really, how many days has this been since it really took off here on June the 2nd? So it's been this month, but it's been, let's see here, 10 bars. So it's been 2 weeks that crude oil has been rallying. If you look at the rate of change for crude oil over the past 10 trading sessions, let's change this here to 10. So when you look at it over the last 10 trading sessions, I mean 20%. That's a pretty good run in 20 days. But you can see, and it is, the second biggest move outside of this move here, where we went up. How much did we go up in 2 weeks? We went 36% in 2 weeks there. Most of it coming really in 1 week. But if I were to zoom out and include a little bit longer of a time frame, obviously the jump coming off of COVID, you can't really, because we went negative, and it's that's not really normal. So we really can't count that, even though it's a pretty decent jump in a short amount of time. You can see here in January of 2019, it was a 20% gain off of a significant low point that started a bullish run, right? So this started a little bit of a bullish rally. We were coming off of 42. We ended up going up to 66. So that kind of started a bullish move. And you can see 2016, we also had a 20% gain in 2 weeks, again, coming off of a low that started a bullish run. And we're kind of coming off of a low here. So, theoretically, we could be starting a bullish run up to the upside. I mean, obviously, it's not as bearish as what we saw in some of these others. Right, like in 2019, we had really come down quite a bit in a short amount of time. Same thing with 2016. Again, we had dropped a lot in a short amount of time. Those are both kind of global slowdown time frames. This is more of a headline driven, not necessarily a global slowdown like those two instances were. So I don't expect that this will be starting a new strong run to the upside on crude oil. I think it's going to be very temporary. Because remember, again, higher yields, higher dollar, higher commodities. That's the three-headed monster, and that's what we saw today, right? We saw higher dollar, higher yields, higher energy, and the markets were bearish. So we don't want to see a lot of that, and I don't think that we will. I don't think either one of those three indicators yet are poised for strong bullish moves up to the upside. All right, let's take a look at the breadth. The breadth turned south today. It did not drop below minus 35, but it turned negative. We're still easily above positive 500 on the summation index, so no issues there necessarily. But still, it's pretty negative for the summation index. If you take a look at the net new highs and new lows, let's pull that up here. So the net and new highs and new lows here. Pull up my stock charts, and let's see, it's on this chart here. You can see the sentiment's turned, the net sentiment has turned bullish. You can see the histogram is pretty strong. So a pretty significant change in sentiment from as strongly bearish as we were up to even just slightly bullish is a big change. If you take a look at the net new highs and lows, we went negative today. So, if you look at the actual number of new highs and new lows, Still they're still relatively low. You have to add on for that chart here. It takes a look at the Nasdaq Composite as well, so you have to add these, and we were almost 200 over 100. So we were net. Like, this is the first time in a few weeks, so we've been net negative on the new highs and new lows, but we did not drop below minus 100, so that's a positive development. The number of stocks above the 50-day average dropping slightly below its average, but still, again, not necessarily breaking hard. The number of stocks above the 200-day moving average did drop below its average, not so slightly, a little bit more, but also slightly dropping below 250, right? So that's a little bit of a drop in breadth. Now we're not breaking down hard, so there's no issues or concerns here. And remember this, there's two ways that this ratio chart can break up above its average, which it has not yet. But if it does it like today, if we get more of like today, then we're concerned. But if today is just an anomaly and we jump back, we get a lot more stocks bouncing back up here above the 200-day moving average, then we'll ultimately just be fine. So breadth was negative, but really today was the only negative day out of all of them. And now let's take a look. Now here's the interesting thing about the sector performance. It really was, it was energy and nothing else, right? And it was an energy world. But it wasn't just today. Again, if I look at, today first, energy was a big loser, right? A big loser. Big winner, excuse me. Everything else were big losers to the downside. Utilities, healthcare, real estate outperforming, with financials really struggling, but energy was up. But if I zoom out, this hasn't been a one-day phenomenon. It's been going on all week, right? Energy's been up 5%. We were already up 3.5% on the week. Now it's up 5%. Technology finished the week slightly positive. Industrials, financials, other cyclical areas, XLC, all were negative this week, with the S&P down 0.3%. So it's we've talked about this before. We do not want energy to be leading the way higher, right? That is not a sector that we want to see gaining strength. And you can see, like, the week that we had here, this is a weekly chart. That's a pretty good week for energy. It's had some negative relative strength and negative momentum, and it's been below a falling 50-week moving average. But when I look at the daily version of this chart, we'll go to the still 1-year chart, then you can see the parabolic move it's on and getting above its 50-day average, the relative strength chart getting above, with rising momentum, and the relative strength chart, which had been pretty negative, is moving up. If I take a look at it here, XLE relative to SPY, here's that chart, and we'll switch it back to a daily chart. So let's go 1-year daily here. And you can see we're above 60 on the RSI. We're above. This is the ratio chart, above its 50-day average. Still bearish, still below the 200-day. The PPO is positive now. The long-term PPO is potentially rising. Big strong move on the CCI. Like this might not be a 1-week phenomenon. We might be headed towards more relative strength and energy. And as you can see here with this negative correlation, that's not what we want to see. So, that's something to pay attention to. Again, it seems like crude oil, this move this week, is just a temporary phenomenon. It doesn't seem like it's corresponding to anything more than just this headline-driven thing. So we'll see if it turns into something more than that, because it's not like we've been. It's been bearish, but it's not like it's been bearish because of an economic slowdown. We had a bad quarter, but for the most part, energy's been underperforming for more than just the first quarter. So, other periods of time where it started the bullish trends, energy had been weak because of economic slowdowns, 15, 16, and 18 and 19, right? These are all economic slowdowns here, and then COVID was the economic shutdown at that point. This decline here wasn't really an economic slowdown, a global economic slowdown, and so it's like, because the markets, like over the last couple of years, GDP has been pretty good, except for the first quarter of this year. It's been pretty good. So I don't think that this is necessarily going to spark something new like we've seen coming off of other lows, right? Coming off of that low, and in 2019, and we never did cut. The relative strength never did come off the low, even if crude oil itself did. Energy stocks did not, because technology stocks were just so bullish during that time frame. So that's what we see here. And again, like I said, very strong moves. And this PPO kind of suggests that we might be headed towards some positive. And again, considering the correlation, I don't know if that's necessarily something we want to have happen. Well, that does it for today. You've heard from me now. Now I want to hear from you. Comment on today's market outlook with today's tweet at the bottom of the post. You can also scroll all the way to the bottom of the post and comment on the post itself, the blog post. I want to hear what you're thinking. What do you think about what we talked about in the video? What do you think about the market right now? You can also comment on the YouTube video as well. Join us at marketscholars.com. We talked, it's the last day that this video will be posted publicly. So make sure you're signing up for our foundation tier to continue to watch the full version of this video going forward. Like us and comment and subscribe to our YouTube channel. Have a great rest of your weekend. Happy Father's Day to all the fathers out there and grandfathers listening to and part of our Market Scholars community. I hope you have a great one, and we'll see you all on Monday.